Hello everyone, welcome back to CA Foundation Principles and Practice of Accounting Marathon Revision. I'm your CA Rajavardhan. You might have seen me in the last three parts. Here I am in part 4 or lecture 4 of your CA Foundation Marathon Revision. In the previous part, that's part 3, we did unit 1 of chapter 6 and unit chapter 5 as well. So now we're continuing chapter 6 from where we left. We finished the chapter of bills of exchange. In this, we'll be doing goods and return or approval, consignment, average unit account, current, and how much of final accounts is possible. Let's see, and the remaining we'll try and finish it in next. That is the lecture 5 of our marathon. So before we get started with sale of goods on approval or return basis, a small announcement to all of you people. Mega revision free test series is being conducted on Unacademy application for June 2022 aspirants. This is happening on 15th of June at 2 p.m. It's going to be 30 minutes, 20 MCQ questions, which is must go for all of you aspirants aspiring to write your exam in the month of June 2022. The dates are announced for law, maths, and economics as well. June 18, June 21st, and June 23. Avail this benefit of free test series, give it a go, and then test your preparations for examination. Another important thing that you need to note is CA Intermediate Mega Combat is coming up on June 12th, and this will give you huge discounts on your CA Intermediate subscription, which is a very important, vital thing that you guys would need, considering that CA Intermediate examination is what you're going to prepare for next after your CA Foundation examination. And you can also take up CA Iconic program, the flagship model of Unacademy. Recommend all your friends and what to say people whom you know to take up this for their November 2022 batch. Yeah, so Iconic subscription will give you great features like one-to-one mentoring, one-to-one personal coaching, doubt solving that can happen one-to-one. Printed hard copy of your material will be sent to your doorstep from the Unacademy team. Evaluated test series is available. You get to be part of industrial experts sessions taken by experts, and you also get to be part of not discussion channel for all your works. The usual plus benefits like live classes with recorded backup being available. One subscription giving you access to all the lectures is definitely there. So what are you waiting for? Take up your Unacademy subscription today. Subscription for CA Foundation is now available at 41,000 for 24 months, 28,600 for 12 months, 20,500 for 6 months. And you can avail 10% off on the same by using the code YESHASLIVE, which is YESHASLIVE. And when you download an Academy application, don't forget to follow me, CA Rajavardhan, on the Unacademy platform for all the updates of future classes that I'm going to take in the free class platform, future batches that I'm going to launch for foundation, intermediate, and beyond. So, see you there. Now, let's get back to business and we will discuss Unit 2 sale of goods on approval or return basis. There is a file in which I've discussed how many marks can each chapter come for, what are the important topics to revise, and quite a lot of other things. You guys can revise this. Now, I would prefer taking this up from our Excel sheet. Yeah, this is our class discussion sheet for the same attempt what which you people are writing for. Yeah, goods sent on return or approval basis. Under this, no, the deal is like this: you don't sell the goods, the person is not willing to buy, so you convince him by giving the goods to him as a option to return if he doesn't like. So you give the goods to him and then say, you keep the goods, you try to sell it. If you sell it, you give me money. If you don't sell it, then return. No, I'll accept. But you give it to him with a time condition, saying that within next 1 month you either return the goods to me, or if you don't return within 1 month, I want cash in. After 1 month, I'm not going to receive the goods back. Why? Now if I give the goods to him and I give him an option either to return or accept, he doesn't accept, doesn't return, he just keeps the goods in the godown, then my goods are rotting. No, there, if in case if I wouldn't have given the goods to him, if the goods were with me, at least I could have sold it elsewhere. Now I'm neither able to sell it elsewhere nor has that guy accepted. So I'll give him with a time condition. Whenever these goods are sent, it is not sold, it is only sent. That's a very important point you need to remember. At this junction, organization has two options. One, it can record it as sale when the goods are sent, or it can not record as sale when the goods are sent. It can wait till acceptance to record. However, majority of the case they write the entry of sale whenever it is sent. If the entry is written at the time of goods being sent, entry is debtors accountable to sales. Or you can wait to write the entry on the acceptance, then there will be no entry. Now, if the goods are accepted at the original rate, they accept, then you don't have to write sale entry here because you have already written the sale entry when you sent. However, if you have not written the entry when the goods were sent, now when the goods are accepted, you would have to write the entry debtor to sales. Got it? Now this is accepted at original price. Certain times you send the goods to them at one price, but when they are accepting, you can force them to accept it at a higher price and collect higher money. If you are collecting higher money from them, assume that you send the goods at 10,000 and now you are convincing them to buy it at 11,000. So 10,000 ke liye already entry is passed. For the additional 1,000, you will now write the entry. However, if it was not entered here, you would freshly write the sales entry now at the increased price, at the price of 11,000. Or certain times it can also happen that the goods are accepted at a lower price. If it is accepted at a lower price, what would you do? Here you have already written the entry at 10. Now they are accepting it at 9. You would decrease 1,000 rupees by reversing the entry. You would write sales to debtors. You would reverse the same entry what you posted in the past. Okay. So then this is written for difference between the new one original price. That is for the decrease you write this entry. Got it? Or if your entry is not passed at this stage, then the fresh entry only will pass it for the decreased price of 9,000 rupees and then got it. Then if the goods are returned within the time given, then that is not a sale. No, previously would actually pass the sales entry, so we would have to reverse it. If the sales entry was not passed when the goods are sent, then there is nothing to reverse. No, when they return the goods to us, we will not write in it. Why? When we send the goods, we didn't write in it. When they return the goods, also we don't have to write in it. Got it? Perfect. Then at the end of the year, if the goods are neither accepted nor returned, then comes this beautiful part. The sale entry what we wrote in the beginning is not sale any longer. It is sale only when they accept. Now we have to reverse the sale entry that we had earlier passed. So I will write the entry as sales account debit to debtors account. First one, this would be obviously at selling price. And nextly, when I count the inventory in my go down, I did this in chapter 4 if you remember. In the second video we had done this, part 2. When I count the inventory in my go down, that inventory is not there. Why? The possession of this inventory is with my customer, but it belongs to me. I have not sold the goods to him, I have only sent the goods to him. So the possession is with me. Sorry, possession is with my customer. Ownership is with me, and I have not sold it to him, I have only sent it to him. That inventory should be included in my stock, but it's not physically available with me. So I would have to write the entry trading account, sorry, stock with customer account debit to trading account. This entry has to be written at the cost price. We'd have to reiterate that selling price to cost price and then record. However, if the sale entry was not recorded at the time the goods were sent, you don't have to reverse the sale entry. But what is must is recording such inventory into our stock, because when we count our stock, it is not available in our godown, but we have the ownership, though we don't have the position. So we need to write the entry stock with customer account debit. This would increase our closing stock in the trading account credit side as well as the balance sheet asset side. This will have an impact on our financial performance as well as the position. A very important point here is when we reverse the sale entry here, we'd have to write sales account debit and it should not be written to sales return account, because it is sales return if it was previously sales. Previously it was not sales, so now it is not sales return. It is reversal of the sales entry that we had passed. I hope you guys understood this point. Fantastic. And next year when the goods are accepted, we'll write the fresh to sales entry, debtors to sales. And it doesn't matter whether the entry was previously written as sales or not. Why? However, it is adjusted at the end of previous year. Done. And if the goods are returned, then there will be no entry, because it's already reversed. No? Entry is already. This is the accounting entries. This is done when the scale of operations is too less. When the number of operations or number of entries become little more. No, I'll show it to you here. Yeah. Depending upon number of operations, organization might follow different methods for accounting goods into return or accrual. If the transactions are few, then like what I discussed now, we can write sales entry, or we can wait for acceptance and then write sales entry. That's what we discussed just now, this part. However, when the transactions are many, organization has an option to prepare a multi-column journal. It will be like a journal book with multiple columns, wherein you will write goods sent, goods accepted, goods returned, balance. Get this? Then whatever sent is written in sent. If it is accepted, it will be written in accept column. If it is returned in return column, if not in the balance column. Done. And then you have, if the transactions are too many, then we prepare a separate day book for sales and separate day book for returns. I'll show you the format of these two also as to how is it prepared. It's quite easy, not very difficult at all. And this chapter is a lottery chapter. If you get a question from this chapter in the exam, no, you should not write the answer. You should say yes. Celebrate first. and then write the answer. Because lottery, congratulations brother, congratulations. That sort of chapter this is. This is our multi-column journal, guys. So in the multi-column journals, as I mentioned previously, you would prepare three major columns. One is goods sent column, second one is goods returned column, third will be goods accepted. Whenever the goods are sent, the date on which it is sent, the name of the party, and the amount will be written here. If the same party accepts it, you will write it in the accepted column. If he returns it, you will write in the return column. If he neither accepts nor returns, then you can write in the balance column. Simple to do. There are a couple of questions you can practice. It is actually waste of time. Just see the answer only. That will be more than sufficient. I am usually a person of practice. I force students to write and practice, but I myself am telling you this is a chapter where practice is also waste of time. Just see the answer, how the answer is. One point is certain answers in ICA material, they have not given so many columns. What they do is they keep date and particulars column common, and they'll write goods sent, goods returned, goods accepted, balance as four columns separately. You can do that also. Instead of writing repetitively, you can write date, you can write particulars by name of the party, how much is sent, how much is accepted, how much is returned, balance. Those four columns can be written together. Meaning you are writing this date and particulars column in common for all the three boxes together. That is possible. Done. Then I told you separate day book. The separate day book looks like this. It's sale or return day book. Here you will write the goods sent. You will write the goods sold, meaning accepted, returned, balance. Simple. Here is the goods sent. Here it is accepted. You will write here. Returned. You will write here. Total will come here. And balance is neither accepted nor returned. Time to return is still there. That's it, guys. A very easy chapter to do, which I don't want you guys to miss out at any point of time. Got it? Please do this topic without fail, without regrets, and see you all on the other side. So by this we finish chapter 6, unit 2, which deals with goods sent on return or approval. Now let's get started with consignment accounting. Chapter 6, unit 3. Everyone ready? Ready, guys? Fantastic. Chalo, let's start with consignment accounting. So consignment accounting entries are here. I think the basics, no, we'll revise it from a different place. Let me open this file. So this again happened to be in the special class. I wrote and discussed this in the Unacademy special class platform only. If you want, you can ask me. I'll share the link to this. It's a little longer one. So whatever I discussed over 4 hours or 5 hours, I've confined it to here and I'll finish it in the span of 15-20 minutes. Got it? So what exactly is consignment? It is unlike normal sale transaction. It is not a normal sale transaction. It's a transaction where there is a seller, there is a buyer. In a normal sale transaction, you sell the goods, you receive the money. That's a normal sale transaction. However, in a consignment, what happens is you send the goods to this intermediary. He has to sell the goods to customer. Customers are here. You are here. In between is another person who's called as consignee. So you are consigner and you have an agent by name consignee. You send the goods to consignee. Consignee will sell the goods on your name. And consignee will collect the money from customers and he will give that money to you. Got it? So you consigner are principal, your agent is a consignee, and the relationship between both of you is not that of boss and labor or employer employee. The relationship is that of principal and agent. He works for commission under. Get this? You will have the ownership of the goods throughout, but he will have the possession. Sorry, you will have the ownership. He will have the possession because you are the owner, but he will try to sell the goods on your behalf. So when you give the goods, you are only sending the goods to him and not selling the goods. If you sell the goods, you raise invoice on him. If you only send the goods, you can't raise invoice. So what you do, you give something which looks like invoice, but it is not invoice. Which looks like an invoice, but it is not an invoice. That's what we call as pro forma invoice. Pro forma is format. Invoice is the bill. So it will look like a bill, but it is not. And after he sells the goods, and whenever he sells the goods, he keeps an account of the sale transactions. If it is his own sales, he would have prepared sales account, but it is not his own sales. It is sales that he is making on behalf of his principal or consignor. So he will prepare a document called as account sales. He'll record everything there, and then along with the money that he collects, he will send this account sales to consignor. So consignor prepares pro forma invoice and sends it with the goods to consignee. Consignee will sell the goods on behalf of the consignor, and consignee will dispatch the money or remit the money collected by him from the customers along with the piece of paper containing all the information, and that paper is what we call as account sales. I hope you all understood. Fantastic. Let's go ahead. In the process of consignment, there's going to be a lot of expenses incurred. Yeah, like it's not like pack all the goods and the consignor says go. It will not go. You have to incur some expense. That expense will be packaging, loading, unloading, insurance, everything. Yeah, certain part of the expenditure will be incurred by consignor. Certain expense will be incurred by consignee. Consignor will incur the expense of packing, loading, insurance, transportation till consignee city. Once it reaches the city where the consignee is there, consignee will incur the expense to move it till his godown. Then he has to unload. Then he has to unpack. Then again he might take insurance. He might incur storage expense and lot of expenses. All these expenses, whether incurred by the consignor or incurred by the consignee, are to be borne by the consignor. Very important point. Yeah, see this. All the expenses, whether paid by the consignor or paid by the consignee, it is to be borne by the consignor. It is to be borne by the consignor because consignor gets the profit. Consignor is the owner. Consignor should bear the expense. Consignee is an after all agent. He gets commission only. He will not bear any of this expense. So I've given a lot of rules that you need to remember in the consignment chapter as hashtags. Hashtag 1, hashtag 2, hashtag 3. These thumb rules will help you remember everything that's to be known in this chapter. So rule number 1, all expenses, whether incurred by consignor or incurred by consignee, is to be borne by consignor. I hope you all got this. Let's go to the next part. Now classification of expenses. There are two classifications that we do. That is non-selling expense and selling expense. Recurring and non-recurring is the other names. Non-selling expenses refers to all the expenses incurred till the time the goods will reach consignee's godown. For instance, in this expense sheet, packaging expense, loading expense, insurance expense, transportation to consignee's city, and transportation till consignee's godown. All of this is NSE, non-selling expense. So entire expense incurred by consignor and expense incurred by consignee till the godown is non-selling expense. Once the goods reach the godown of the consignee, any expense that the consignee will incur, storage, rent, security charges, all of this is non-selling expense. Sorry, is selling expense. Is selling expense. And these selling expenses will not be included in the computation of value of closing stock at consignee. In the consignee's godown, there will be some stock left, no? When we try to find the value of such stock to be included in our books of accounts. I told this to you in second part or second lecture when we were doing valuation of inventory. Goods lying with consignee needs to be included by consignor. He needs to include it in the computation of that consignment stock value. Will always consider non-selling expenses, but will never consider selling expenses. Read this: non-selling expenses. Expenses incurred till the time goods reach consignee's godown. Can be incurred by consignor or consignee. This is like direct expense. Selling expense. Expense incurred after the goods reach consignee's godown. This is like indirect expense, my friend. Got it? Yeah. Scroll down. Rule number 2. Non-selling expenses and selling expenses both are considered in computation of profit. Hey, when we compute the profit, both the expenses are considered. Both are debited to consignment account. Both are to be borne by consignor. Any expense, non-selling or selling, if it is paid by consignee, consignor has to reimburse it. However, in computation of closing stock, only non-selling expense is considered. See rule number 3. Only non-selling expense is to be considered in the valuation of unsold inventory. Got it? So 3 rules, all the expenses covered. I hope you all understood. So let's quickly go to the next part. Now, I told you consignee is an agent, he works for commission. Whenever he works for commission, commission is the income to consignee, expense to consignor. Consignor has promised the commission to consignee. When he gives that pro forma invoice, no, along with the goods, in that all by itself he'll mention how much commission or how much per unit or how much percentage the consignee is eligible for as commission. And based on that, the computation will be made by consignee. And after the consignee collects the money from customers, he will deduct his portion of commission and only the balance will be remitted by the consignee to consignor. Got it? And that commission computation, commission deduction and expense deduction, everything consignee will give it in account sales. Yeah, account sales will tell how much money is collected from sales, how much is deducted towards his commission, how much is deducted towards the expense that he has incurred, and how much is the money remitted to consignee. Every detail will be mentioned. Got it? So let's quickly see commission to consignee. It can either be given on per unit basis or percentage basis. And remember, consignee is entitled to commission on goods sold by consignee and not on goods sent. As a consigner, if I send him 1000 units, but he sells 800 units, I can give him commission on 800 units only. I can't give him commission for 1000. Why? 1000 units he received only, no, he didn't sell. You will get commission when you sell, not when you receive. That way, if any one of you are willing to give commission for goods received only, tell me, I am more than happy to become your consignee. You send me any quantity of goods, I am ready to receive, also ready to receive commission. What's that? Ready to send goods? Ah, I will be your consignee. Will you be my consignor? The deal is you should pay me commission on goods sent, not on goods sold. I really know that your answer is no. Little disappointed. It's okay. Let me go further ahead. Let me make you happy by teaching the next part of consignment chapter. Forms of commission. There are three forms of commission. There are three major types of commission: ordinary commission, del creditor commission, overriding commission. Ordinary commission is also called as normal commission. Ordinary commission or normal commission, it is for selling the goods on consignment. It can be on per unit basis or percentage basis. As a consigner, I'll tell boss, I'll give you 10 rupees per unit sold, or I can say 10% per unit sold. Either ways is fine. If it is percentage, total sale value multiplied by that percentage. If it is per unit, number of units sold multiplied by that per unit commission, you get the commission under normal commission or ordinary commission basis. Fantastic, very easy to do. Congratulations. Let's go to the next one. Shall we? Okay. What comes after this is del creditor commission. What is this del creditor commission? Now we know that for a fact that any commission or any expense, whether it is incurred by consignor or by consignee, should be borne by consignor only. Yeah. One beautiful expense that grabs lot of attention is bad debts. Sir, what is bad debts? I've sent goods to consignee. Consignee will sell the goods. The sale of goods can be cash, can be credit. If the goods are sold on credit, it will be debtors. If the debtor pays money, consignee will collect and then pay the money. If debtors doesn't pay money, that is what we call as bad debts. No, bad debt expense consignee will not pay. Consignee will say, brother, if you're giving me profit, you give me loss. If you're not giving me profit, you give me only loss. What? Do I look like meh to you? No, no. Obviously, I am not Bakra, I can't take it. You take loss, you take profit, give me only commission. After all, agent. No, what will I work for? That's what the consignee will say. Get what I'm trying to tell? Fair situation, consignor has to bear all the expense, he'll bear bad debts also. But consignee is a smart guy here. Very, very smart. You know what the consignee does? Consignee wants higher commission. If you want higher commission, what should you do? You should sell the goods. More goods you should sell for more commission. Selling the goods is not an easy job. Sales is not an easy job. I hope you all understand the fact that sales is not an easy job. Yeah. Now sales is not an easy job. How do you deal with this? Consignee is a smart guy, I told you. You know what the consignee does? He will go ask everyone and then say, do you want goods? Do you want goods? They will say, no, I don't want. Consignee will say, free. People are like, literally free. Free means give one for me, one for my girlfriend, one for my ex-girlfriend, one for my ex-girlfriend's boyfriend, one for my neighbor, one for my neighbor's girlfriend, everyone. You take goods for everyone. If it is free, who says no? If it is free, even if you don't want, you take it. So people took it. Then this guy told, but I will not call it free. I will call it credit sales. Then suddenly people like, hey, no, 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 I don't want. Credit sales means I want to pay you money later. No, I can't pay money. Take your goods. Take your goods. Then the consignor is like, hey, listen, no. I will give the goods to you. It is actually free, but I will tell it is credit sales. You should accept that it is credit sales. You should accept that you will pay later. Later, formality sake, I'll ask you for money. Formality sake, you tell that you don't have money. I will inform my consignor that it is bad debts. So to you, goods are free. Then that customer will not ask a second question. He's getting free, no? He's like happy. Now, consignee, why did he do this? The consignee wants some name, no, to sell the goods. Now, if he makes sales genuinely, sales is less. If you make sales like this free types, sales will shot up. No? When the sales shoot up, what will happen? Consignee will get more commission, boss. But what about the boss consignor? Consignor will be in very, very bad place. You know why? He's first happy. Oh, you sold so many goods. Oh, nice, nice, nice. But credit says, I understand, it's okay. Business happens on credit only, no? It is okay, fine. You take your commission, you take. He'll give commission to consignee. Later, consignor will ask, hey, where is the debtors come money? Then consignee will be like, Sir, very bad. Customers, sir, they didn't pay money. I tried very hard. Oh, fine. You can't do anything. You're after all an agent, no? It's okay. Book bad debts. So, consignor is losing goods. Goods given away free, lost to him. He is also losing commission expense. Oh, so two sides where consignor is getting hit. Consignee is happy. Aha, commission. Customer is happy. Aha, free goods. Who's the only crybaby? Consignor. Is it fair? It is not fair. Consignee one fine day, consignor will one fine day understand this. How? He'll see someone holding it like, hey, that goods I manufactured. That customer is like, this goods I got it free. Then the consignor is surprised and shocked. How did you get it free? I know a friend who gave it to me for free. Then he'll ask, who's your friend? His friend is consignee. Now consignor has understood the entire scene. He will call the consignee and then say, hey, what are you doing? What do you think you are doing? You can't do like this. I am incurring product loss plus commission loss. You want more commission? Ask me. I will give you more commission. Take Del Credit commission. Enjoy. But I am giving you extra commission. You will get extra responsibility. From now, if any customer doesn't pay money, boss, it is not my responsibility. I will deduct it from your commission. So del creditor commission is paid by consignor to consignee to pass the risk of bad debts. Pass the risk of bad debts. Whenever consignor pays del creditor commission to consignee, bad debts expense will not be borne by consignor. It will be adjusted against the commission of the consignee. Got it? Fantastic. Del creditor commission paid by consignor to consignee and bad debts will be borne by consignee in this case. And on what do we compute this del creditor commission when it is given as a percentage? People say, sir, credit sales. Answer is wrong. Del creditor commission should be computed on total sales only. Unless it is specifically mentioned in the question, requiring you to compute it only on credit. Done? So remember rule number 5. Unless specifically mentioned, always compute del creditor commission on total sales and not only on credit sales. Remember, let me repeat. Unless specifically mentioned, compute del creditor commission as a percentage on total sales and not only on credit sales. This is rule number 5. I hope you're all remembering the rules that I shared with you people. Chalo, let's go to the next one. Overheading commission. In this, again the consignee is smart. He is good smart, not bad smart. Consignee is smart like this. You are a consignor. You send the goods to consignee. Ask him to sell the goods at 100 rupees. Consignee is now convincing the customer to buy the goods at 120 rupees. Now, if he sells the goods at price higher than what you quote, you will get more profit. You are happy. Consignees put in extra efforts to get you more profit, but you also need to reward the consignee. So, what you do is for the sales made at a price higher than the expected selling price. If the consignee sells the goods at the price higher than what we quote, then we give him extra commission over and above normal and ordinary commission. Such commission what is given over and above normal and ordinary commission to consignee for him making the sales over and above the normal selling price is overheading commission. Quickly see this. Yeah, for extra profit or revenue generated by consignee, that is if consignee sells the consignment stock at a price higher than what was suggested by consignor, in such a case the overheading commission should be computed on the surplus amount only. Okay, now with regard to del creditor commission, I told no, unless mentioned compute it on total sales. Del creditor commission, that overheading commission always compute only on surplus, not on total sales. What is surplus? That extra sales revenue generated over and above normal selling price. That is rule number 6. What is it? Ordinary commission should be always computed on surplus only. What is surplus? Excess of actual selling price over the expected selling price. Got it, guys? Fantastic. These are 3 types of commission that needs to be paid by consignor to consignee. Next thing is loss of goods sent on consignment. Whenever the goods are sent, goods can get lost in the process or at the go down. This loss is called as 2 types, categories into 2 categories: normal loss, abnormal loss. Normal loss is unavoidable loss, loss which cannot be avoided. It is like inevitable, no matter what you do. Abnormal loss is loss which can be controlled with perfect measures. So whenever there is normal loss, we adjust it only in units. See, when we write units per unit price and amount column, Only normal loss is adjusted only in the units column. We reduce number of units. So if there are 100 units and 10 units get damaged, and if it is normal loss, the remaining 90 units per unit cost will shoot up. So good units will bear the cost of bad units. That is in the case of normal loss. However, in the case of abnormal loss, the per unit cost will not shoot up. Abnormal loss will be posted to P&L account. There is journal entry. Here only adjustment, no journal entry. And this is not going to change the per unit cost. So remember, normal loss will increase the cost of good units and there is no journal entry. It's only adjusted. Abnormal loss will not change the per unit cost. Amount relating to those units loss will be transferred to P&L account. Got it? Fantastic. See, normal loss will increase the per unit cost of good units. Abnormal loss will have to be charged separately to P&L as expense. It will not change per unit cost. I hope you all understood this. Yeah, so this is the process. See, if it is normal loss, we'll deduct it here in units column, and this will become more. If it is abnormal, this will remain same. Total amount will remain same. Number of units will reduce. However, if it is abnormal loss, we will deduct it in the amount column also. This will also reduce, and then number of units will also reduce. Rate per unit will remain same. Yeah, if you do a problem on this, you'll understand. And couple of important points, the same thing what I told right now. Normal loss is to be reduced in units column only. Abnormal loss is to be debited to P&L account. So that's the point. And last few points is, remember this: accounting for consignment, when you start doing journal entries, these points to be kept in mind. Ownership is with consigner, possession is with consignee. Sale is made by consigner, profit or loss is booked by sale is made by consignee, profit or loss is booked by consignee. Got this? So if you know this much, then we can start with accounting entries. Accounting entries, once you understand, then you will be done with this topic of consignment. You just have to solve few problems by preparation of ledgers to understand. Let's finish it off with this kind of sheet only. In the books of consigner, in the books of consignee, what will be the entry? When the goods are sent on consignment, consigner will write the entry consignment account debit to goods sent on. Consignee will not write entry because he doesn't have ownership and he doesn't own the goods. No, so no entry. Got it? Very good. Next, consigner. When the expenses are incurred, when the consigner pays the expense, he will debit consignment account, credit cash or. Hey, remember this. Any expense, whether incurred by consigner or by consignee, always debit consignment account. Got it? Yeah, we'll write consignment account debit to cash or bank. Consignee will not write entry. It doesn't affect him. If the expense is paid by consignee, consignee will write the entry consigner to cash or bank. Why? Consignee is supposed to recover this money from consigner. Consignee has paid this on behalf of the consigner. So he will debit consigner account and credit bank. And consigner will write consignment account debit. He will not write cash. Why? He didn't pay cash. Who paid cash? Consignee paid cash. And we have to pay such money to consignee. So I'll write consignee account credit. So entry will be consignment account debit to consignee account. Got it, everyone? Fantastic. So expenses on consignment done. Next up, loss of goods sent on consignment. Whenever the goods are sent on consignment and it is lost, for normal loss, so both of us will not write entry. For abnormal loss, if the goods are not insured, I will write P&L account debit to consignment. P&L account debit, because in P&L account debit side this needs to be written. Consignment account credit, because the consignment stock value is reducing. However, if it is insured, to the extent it is not insured, I will write P&L account debit. To the extent it is insured, I will write insurance company account debit, because insurance company has to pay me money and it will not go to my P&L account as loss. However, consignment account has to be credited. Why? Our consignment stock is reducing, no? So it has to be credited. And then we have goods sold by consignee. If the goods are sold by consignee, consignee will write the entry cash account debit to consignor. Why? Consignee is receiving cash, you will debit cash, and this money has to be paid to consignor, so we will credit consignor account. And consignor will write cash has to be received from consignee, so we will write consignee account debit, and you will credit consignment account because consignment stock is reducing. Again, in the case of credit sales also entry is same, because as a consignor you have passed on the responsibilities of selling the goods, collecting the money either on cash sales or credit sales. Everything is the responsibility of consignee. As a consignor, you have given the goods to consignee, you should collect money from consignee. So I'll write consignee to consignment only for credit sales also. However, consignee will first write consignment debtors to consignor, because consignment debtors they should collect money and he should pay this money to consignor. When he collects the money, he will write cash account debit to consignment. And when the cash is collected by consignee, From the consignment debtors, I will not write any entry as a consignor. Why? I wrote the entry when the sale was made only. I won't write the entry when the money is received from consignor by consignor. Done. If the bad debts expense is there, if the debt creditor commission is paid as a consignor, I will not write any entry. Bad debts will be booked by consignee. He will write his P&L account debit to consignment debtors. However, if debt creditor commission is not paid, then he will write consignor account debit to consignment debtors. It is not his P&L account debit. So he will debit it to us, our account. He doesn't have to pay so much money to us. Credit the debtors, reducing the debtors. We would have to book such expense. I've told you all the expenses on consignment needs to be debited to consignment, and so much money consignee need not pay us. So I've written consignee account. So this is the entry for bad debts. I hope you all understood. Next, last 2 points on consignment that you need to remember. All consignment expenses, whether selling or non-selling, irrespective whether incurred by consignor or not, has to be debited to consignment account. Next one, all sales of consignment is debited to consignee account in the books of consignor. As it is consignee, you has to pay consignor after collecting from customer. So this 10 rules in the chapter of consignment will cover it all for you. So try to write these 10 rules down and then read them. If you want access to this file, please drop in a message to me on Telegram. I'll share this file of consignment with you. It's hardly about how many pages. It is not too many, guys. It is 1, 2, 3, some 15 pages ka file, and it's not too lengthy. If you can read this, you will be able to revise entire consignment chapter in a, what to say, chutki. Yeah, fantastic. Come on, let's me show you the ledger account of consignment for once. As to how will it look. I'll teach you the concept of invoice price and removal of load. Then we will go to the next aspect. So this is the consignment ledger. For all the expenses we're going to debit. Goods sent will come on the debit, and consignor's expense, consignee's expense, bad debts expense, commission we're going to debit. Sales made by consignee, abnormal loss when insured, whatever money is to be collected, and then sales credit on this one, as well as goods sent on consignment return will be credited, and we'll write the balance unsold stock here. We'll find profit as balancing. Fantastic. Consignee account is also prepared in here. Consignee account with regard to the expense that we need to pay him, with regard to the bad debts money if the creditor commission is not paid, and consignment account for commission due, and whatever money that he is supposed to pay us is for the sale, and we'll pay him balance money, whatever money he pays us by way of cash, bank or bill, we'll write that, and if there is any balance, that will be balance carry. This is the money that he needs to, no, we need to pay him. This is the money that he needs to pay us. Got it? Fantastic. That's it. Sometimes in rare scenarios when they ask for goods sent on consignment account, you can prepare this as well. And I'll teach you one last part, that is how to deal with invoice price cases. Certain cases may the company, the consignor sends the goods to consignee at a price higher than the normal price. This is done because the consignor wants to hide the profit. The consignor discloses the entire cost price, selling price, everything to consignee. Consignee might not exist to be consignee. He might become competitor to consignor, looking at the amount of profit that the consignor will make. So what the consignor does is, he will add some load to the cost price and send it to the consignee at invoice price, and ask the consignee to sell it at a price little higher than invoice price, that is selling. If that is there, how the entries are made is what I'm trying to teach you. Give me a moment. This is detailed solution to all the questions that is there in our assessment. Everything in detail with proper working note. The click of a button. So any day you lose your notes, you can look into this and straight away understand it. When the goods are sent at invoice price, see here. So invoice price is cost price plus load, little higher than the cost price, and the selling price will be more than invoice price. Invoice price plus profit. So cost plus load is invoice price plus profit is selling price. So that load amount, whatever is there, no, that has to be removed. Opening stock, goods sent on consignment will be at invoice price. We need to write them at cost price so that we'll get correct consignment profit. On opening stock, we remove the load by writing stock reserve on the opposite side, load amount. On goods sent on consignment, we'll write goods sent on consignment only on the opposite side to remove load. And on the closing stock, which is at invoice price, we remove the load on the debit side by writing stock reserve. On goods sent on consignment return, we will write the same name on the debit side and then remove the load on the same. That's it. Whenever you're computing loss on loss of goods, normal or abnormal, when the goods are sent at invoice price. Please be little cautious, practice couple of problems on the same, and you guys should be able to ace the chapter of consignment after that. Nothing else is difficult after this. So this is the point at which the consignment chapter ends. I hope you people have understood the topic of consignment. Let me now take you all to the next two kuti topics, that is of average due date and account. Shall I? Not the right topic to be talking about or referring to, but you guys are aware of the fact that there is a new proposed scheme coming up wherein CA inter में group 1 and group 2 accounts are not going to be two separate papers but will be clubbed to form one paper, advanced accounting. 200 marks becoming 100 marks means some chapters have to be removed or pushed down. Some chapters of CA inter might come down to CA foundation to make space for which some CA foundation chapters might have to exit. So couple of chapters of CA foundation which might exit will be this average due date and account current, for an obvious fact that this is something which is almost obsolete. Amazing concept but obsolete in nature. So and very easy topics as such. So these chapters might give way and then be let go. Yeah, fantastic. Not to worry. Let's quickly revise the topic of average due date. Shall we? Hello. Let's revise the topic of average due date and account current. Let's do these two quick. Consignment is done. Hello, let's start with average due date. So there is this is the relationship between trader, buyer, seller, lender, borrower. So there are a lot of transactions happening between them, and there are a lot of bills due, which needs to be settled at multiple dates. There are multiple bills, multiple due dates. Settling multiple bills at multiple due dates is time crunching and little difficult. So in order to ensure that multiple bills are settled on one single date, we take the average of all the due dates that are available to us. That is the concept of average due date. So bills due on multiple dates will now be settled on one date. That one date is called as average due date. So how do we compute average due date? Yeah. So the average due date is computed like this. Okay, what is average due date, and do we have the space for formula or something in here? No, we don't have. I need to write it down. Okay. So what is average due date? Average due date is such date on which if the amount is settled, there would be neither any interest payable nor any interest receivable. See, you would have to settle the bills on the due date. If you pay it after due date, you have to pay interest. If you pay it before due date, you will save interest. Like retirement and renewal of bill, what we discussed in the previous video, if you remember. So, what is average due date? We won't settle the bill on maturity date. It will be settled on a date other than the maturity date, but still there will be no interest payable or no interest receivable. Yeah, a date on which multiple bills due on multiple dates can be settled by one single payment without paying or saving any interest. This, my friends, is average due date. So what is average due date? It is the date on which multiple payments can be made or settled without paying any interest or without saving any interest. I hope you understood this. Now, if you settle or if you pay the money after average due date, then you would have to pay money. That is interest. See this? If the date of payment is after average due date, sorry, if the date of payment is after average due date, interest has to be paid, interest expense. If the date of payment is before average due date, interest will be saved, there will be interest income. If the date of payment is average due date, then there is no interest payable, no interest receivable. I hope you guys understood this. Fantastic. How do we compute average due date? For all the multiple dates that we have, we will basically use this formula to compute average due date. A topic which is not very difficult, which I'll run through little very quick. Yeah, so it will work this way. Average due date is equal to, we'll take the base date plus total product divided by total amount. Yeah, sir, what is this base date? This is usually picked as earliest due date among several dates given in the question. However, it can be date other than the earliest due date also. What is this total product? Total product is amount multiplied by period. What is amount? Amount is the bill amount. But what is period? Period is time between base date and the respective due date. For each of the transaction, we'll identify the time gap between the base date and that respective due date, find the period. For the days, for the amount, we multiply with the total, for that amount, we multiply with that period to arrive at product. We'll take the total of that product, divided by total of the amount, add it to the base date, that will give us average due date. And whenever you identify this TP by TA, no, rounding up is required. Meaning if you get 7.6, it is 8. If you get 3.1, it is 4. Any decimal should be rounded to the next number, because what we get by doing TP by TA is days, not amount. And 3.1 days means payment is happening on the 4th day. 3.4 is also 4, 3.1 is also 4. Always do rounding up in this chapter, any very important thing. And though they use the word due date here, the reference is always given to maturity date. And the next kind of thing that we need to revise in this chapter of average due date is, there will be certain cases where there will be bills payable as well as bills receivable. I will show it to you in the Excel sheet and then explain. That will be much better. There will be bills payable as well as bills receivable. Whenever there is bills payable as well as bills receivable, we will apply the same formula, but all that we'll do is, we'll take base date plus difference in total product divided by difference in total amount, and that base date is for all the bills payable and bills receivable together. Whichever is less is what we'll take. Let me show. See, usually we'll do this formula. Average rate is base date plus total product by total amount. However, the amount that I told you was here. See, this is a question. No, this is an average due date with partnership. This ninth one. Have a look here. This is, there are certain goods purchased by green from red and certain sales by green to red. So there are different dates, purchase dates, sale and then amounts, and then sale date and sale amounts. What we'll do is, for all of these transactions here, we'll find one common base date. That is, earliest of all of this is 6th of January. And from 6th of January to 6th of January 0, 6th of January to 2nd of February 27 days. So from 6th of January to each of these due dates, we'll find this period, multiply, and we'll take the base date 6th of January, and we'll take difference of products, higher product minus lower product. Higher product here is 2,45,600 minus 2,14,600. Also should not do this minus this if this is more. Amounts also should do respective, 10,800 minus 9,000. Then we arrive at some fraction, 23.85 days. That if we add to 6th of January, we'll get 30th of January. That, my friends, is average due date. Done. And we'll find difference between this 10,800 and 9,500. That is the money that green should pay red or red should pay green. Yeah. And last point that I want you to remember in this chapter of in this unit of average due date is, certain times they will tell that is willing to pay 100 rupees as interest, or is willing to save 80 rupees by interest. What is the rate of payment? If these kind of questions come, do normal computation of average due date, and interest will be paid when the date of payment is after the average due date. If they are willing to pay 100 rupees by interest, for 100 rupees for that total amount, compute the period. We know the formula for interest, no? Interest is equal to P into T into R. We know the interest amount, we know the total amount, we know the rate of interest. Find the time component, add so many days to average due date. That will be the delayed date of payment because of which interest has to be paid. If they say interest has to be saved by a specific amount, We know the interest amount, we know the principal amount, we know the rate of interest. We'll find the time period which is to be paid before the average due date. Deduct so many days from the average due date to arrive at the date of payment. Yeah, one of the easiest topics in your syllabus. You can definitely ace this if you practice couple of problems from this chapter. Yeah, there is one more question, which is one more type of question where the amount is uniform in all the installments. In such case, what do you do? In such case, you can use a little unique formula, that is average due date is equal to base date plus sum of the entire period divided by the number of installments. This formula, however, can be applied only and only when the installment amounts are same. Each installment amount is same, equal installments, 10,000, 10,000, 10,000, 10,000, 10,000, 10,000. Amounts are same. Then we can use this formula. However, if you think it's an additional formula and you want to do it with the routine concept only, you can still do it. You'll still get full marks. Answer also you'll get. But this will save a little time. Yeah. So that's with regard to average due date concept. We have now successfully completed the topic of average due date. Now, can I take you all to account current? The next topic, the unit 5, fifth unit in this chapter of special transactions. Shall we, guys? Fantastic. Come on, let's get going. So, I've given a little gist of what and all should be revised from this chapter, what sort of questions can be expected. Now, account current can be prepared under three methods: interest table method, product of balance method. The method will be picked based on the number of transactions. However, in the examination scenario, majority of the questions will come on product method only. You will follow interest table method or product of balance method only and only if they ask you to do so in the exam. If not, we'll always be doing product. Why? It will save time. This is the easiest and the most time saving one. So let me see if I've covered some theory here. Yes, I have. Let's quickly revise this from here. So what is account current? It's a statement and it is not an account. Yeah, who are the parties to account current? The parties between which account current is prepared is buyer, seller, lender, borrower, financer, debtor, all of these. And bank account when you have also interest computation, when it is to be done on daily average balances, then you can use the concept of account current. Done. So when is account current prepared? On periodic basis. It's at the discretion between those two parties. They can prepare it for the end of the month, for the end of 2 months, for the end of quarter, 6 months, or any year, left to them. So why is account current prepared? To ease in the credit system. Lot of time what happens is you can't run entirely on cash system. You have to enter into credit system. You have to sell goods on credit and then collect money later. But when you're doing it on credit system, what will happen is that I will sell the goods to you on credit. You would have to give me money. You will take some time to give. But what if you intentionally don't give because that money is earning you interest elsewhere, and you intentionally delay paying me the money because you are earning interest elsewhere? I think you have a genuine problem to pay, so I'll be okay. One fine day, I understand that you are saving your money elsewhere. You have money, but you are earning interest elsewhere. So what do? I will stop selling you goods. You will ask me why. I will tell that actually I don't have goods. I will lie to you. Why? If I sell goods to you, you are buying it on credit. You are not paying money to me on time. But if I give it to somebody else, they are paying me money in 15 days or 1 month time. Later, you get to know that I am selling goods to somebody. So we both start fighting. You will ask me why am I not selling goods to you? I will tell why are you not paying money to me? Then it's all show. It's becoming a problem. So paying money early is again problem. Why? If I start taking money from you early, you would lose out on interest. No, you would want to pay the money only on due date. Who wants to pay money well before due date? Nobody. So in order to ensure that, what we do is, any goods that I sell to you, I'll treat it as loan given. Any money that you give to me, you will treat it as loan given. From the day I sell the goods, I'll go on computing interest. From the day you give the money, you will go on computing interest till the end of the period. Sir, why 2 ways? Interest should be computed only from date of sale to date of settlement. No, that will become tricky, difficult. So what I do is, from the date of sale till the end of the year, I'll go on computing interest, treating the sales made as loan. From the date of payment that you make to me till the end of the period, you also compute interest. Assume that I make the sale to you today, you make the payment also to me today. I also will compute interest for 30 days, you also will compute interest for 30 days. 30 days interest receivable, 30 days interest payable, it will become zero. If in case I sell the goods to you today, you pay the money to me tomorrow, I will say I have given you loan for 30 days and compute interest for 30 days. You will compute interest on me for 29 days. Net difference is 1 day. Sir, this is more complicated. No, this will become easier because computation will become easy. Now, when we're doing mental mathematics, it is difficult. But on paper, no, rather than identifying one day and then identifying interest on the same, this is easy. Why? You can flexibly make payments. Now, you bought goods from me for 10,000. You can pay 2,000 rupees to me today, 6,000 after 1 week, and then balance 2,000 later. You don't care. Why? Whether you pay or you don't pay, interest income is same to you. Interest is same to you. Why? If you keep in the bank, you get 6% interest. If you pay to me, 6% interest will become cut off. So either ways, paying money, when to pay money will not become a point to be decided. It will become a decision less taken. One less decision to be taken leaves you with more time to do more business and concentrate more time on the business, on business expansion or a lot of other things. That's a great breather. I hope you understood what am I trying to tell you about the interest computation and account current system. Yeah, so there are three methods in preparation of account current. One is interest table method, two is product method, three is balance of product method. Got it? And name or heading of the account current is very crucial part. Majority of the students mess up this easy chapter also because they write wrong name or they understand the question wrongly. Now, remember this recipient first followed by sender's name. In the name of account current, if I am sending the account current to you, yeah, I will write the journal, I will write the heading as you in account current with me. You in account current with me. That's what I should write. You get this? Recipient in account current with sender. That's how it should be written. Because A, B, C, D, E, F, G, H, I, J, K, L, M, N, O, P, LMNO PQ RST. Remember LMNO PQ RS. R first, S next. So recipient first, sender next. The name of the account current should be recipient in account current with sender. Got it? Fantastic. So always write it as recipient in account current with sender. And this is prepared by sender. So always remember that when you're preparing account current, it is like in the books of sender, you're preparing a recipient's account. So what do you remember? In the books of sender, you're preparing a recipient's account. So write in the books of sender, recipient in account current with sender, prepare normal ledger, and then identify the date on which account current is prepared for each of the transaction. From the date of transaction till the date of account current, identify the period. For each of the transaction, let me repeat. For each of the transaction, from the due date, if it is there, to the date of account current, yeah, identify the period. Get this? And each of every transaction, identify the period. And for this amount, for this period, you will compute interest. That is interest table method. Under product method, what you do is, for this amount, you will find the product. Amount into period, amount into period, amount into period, you do. Interest table method में you do amount into period into rate of interest. Here you do amount into period. And later, once you find the product, on the total of the product, you will identify the interest. You will do it like this. Where is it? Where is it? Yeah, I have not written it here. On the product, you compute interest. How do you compute? See here, product is 30,250. You do 30,250 into 1 by 365 into 6%. You will, instead of multiplying 200 into 123 divided by 365 into 6%, 330 into 92 by 365 into 6%. What you do is, you do 200 into 123 here, 330 into 92 here, find the total balancing figure. On the opposite side, you write 30,250 into 1 by 365, which we didn't do here. Multiplied by the rate of interest, you will get the interest. That is product method. Interest table method may individually identify interest. Interest column is closed by transfer the balance to amount column. Under product method, we'll do amount into period, amount into period, amount into period. Find the product, find the balancing figure in the product column. Opposite side in which the product column balancing figure is found, we compute the interest by multiplying by 1 by 365 or 1 by 12, depending upon days or months, multiplied by the interest, and balancing figure is found. Only important thing that you need to remember is, when you take the opening date, this date also should be counted. For all other transactions, you will start counting the period from the next day. That's one point. And if the due date is available, count the due date and not the date of transaction. Second point. Third point is, whenever we compute interest, remember that whenever we compute period, remember that if the due date falls beyond the date of account current. If the due date given here, no, any of the columns, if it falls after 1st of February, then again such the period will become negative. Such negative period is called red ink interest, and for such negative period interest will also be negative. In a regular class I tell in detail as to what is red ink interest, why is it called red ink, and why is it negative. But this is a marathon revision and I don't really have too much time to spare to tell you people. I'm in fact running short of the time. I will not be able to. I'm already done with an hour and I have not started with the topic of final accounts yet. Maybe in this video I'll close it without final accounts, and in the next one I would have to do 7, 8, 9, and then let's see if we can do everything in one next fifth part, or should I be doing sixth part later. It's my headache, don't worry. If in case it demands, I will do 6 parts and then I'll give it to you in 6 parts. Though it was promised to be 5 to 6 hours, it might end up going to 7 hours. Don't worry, my headache. You are getting comprehensive revision. Yeah, okay. So whenever, as what I was telling is, whenever the due date falls beyond the rate of account current, then the period will become negative. So write the period as negative, compute the product as negative, compute the interest as also negative on that transaction, and that's what we call as red ink interest, my friend. I hope you won't forget. Done. And there is one last method. This last method is called as interest table method over product method over, that is balance of product method. So under this method we compute it little differently. I'll show you one of the questions and then explain it to you as to how do we do it in here. There we go. This is what we do. So in this what we do is, we will not write debit side credit side, two things separately. In debit side credit side, when we write date due date particulars column is common, am I right? So we'll write the date due date and particulars column commonly, and amount column will split into two, debit and credit. And after each of the transaction we'll identify whether there is debit balance or credit balance. See here, in the first transaction there is 30,000 credit, so balance will be 30,000 credit. In the next transaction we credit further by 12, so credit balance will go to 42. And after that we debit 26, so 42 minus 26, it is 16,000 credit balance. So for each of the transaction we will find closing debit or credit balances. You got this? And for each of this balance we will find interest. Usually we used to do due date to date of account current for the period column. How did we find period column in interest table method and product method? We did due date to date of account current. However, in here the period is computed like this. We do it from the due date to next due date. This transaction to next transaction. That transaction to that next transaction. That's what we do. So 2nd January to 15th January, period is 13 days, written here. 15th January to 15th February, 31 days, period is written here. We are go on doing that way. For the last transaction, we'll write date of the due date or date of transaction to the date of account current, find the period. And on this 30,000 for the 13 days, we find the product, and ultimately on the balance of the product, we'll find interest. Yeah. So again, a quick revision of what I just told is, under interest table method and product method, period is computed as the time gap between the date of transaction and the date of account current. However, for what to say product of balance method, what we do is the period is computed as the time gap between the date of transaction or due date to the next date of transaction or the next due date. For the last transaction, it will be due date to date of account current. For that period, we find products, debit products, credit products will be there. Difference of debit credit product, whatever exists on that will compute interest and then add it to the amount column to find out the balance. For a problem, if you want, you can do the same problem under product method as well as balance of product method. You will get the same answer. Yeah, you can try this, and by this we have successfully completed the topic of account current also. So we're done with 6 topics, 6 chapters of your CA foundation syllabus in this 4-part videos that we've done. So that's it in this part. We'll be hoping to see you all in the next part, that is part 5, wherein we'll start with the topic of final accounts of sole proprietorships.